Welcome back, everybody. My name's Jonah. I'm one of the banking bros with the Money Multiplier. As many of you know, my day-to-day job, it consists of actually helping many of you use and navigate their infinite banking policies, their personalized banking policies. Of course, we only use dividend-paying whole life insurance policies from mutual companies. And today's problem and solution was brought to you by an individual who called in looking to purchase a house. So today we've got one of our money myths solved by some money mathematics. Now, I'm not going to use his name, for example, but let me give you his scenario and we'll walk through it together. So he called me and he had two questions basically. His first was he said, I've got about $100,000 in a qualified retirement account that I am interested in actually putting into my infinite banking policy. Now, he's got a policy that recently started. It's within the last 30 days, and he let the insurance company know up front that he was interested in doing a dump into that policy, a one time lump sum payment into the policy. So the policy can hold his $100,000 coming out of his qualified retirement plan. His first question was, if I put the money in there, how soon can I take the money out? Because I'm purchasing a house. I let him know that by default, the company that he's using asks for 14 days between the time where he puts the money into the policy, between when he can take the money out as a loan, he can use it for his house buying needs. So he said, actually, I'm closing on the house on the 25th of the month. It's a little too close for comfort for me. I'm not going to do it. I'll use some other money to get it in there because I just don't want to do it. He then mentioned to me the house equation, and that's what we're going to dive into today. He says, I'm purchasing a house. It was an investment property or rental property, I believe. He says, I need 100,000, or the asking price is $100,000 for the house. He says, so I only have to put $10,000 down, 10%. He said, I know I want to do that, but I keep hearing people say that I actually should put 20% down so I can get out of the PMI, the private mortgage insurance. And he said, which one do you recommend? I said, well, first things first, we've got to make sure that we're using the cash value out of your policy to make this purchase. He does have a policy with cash value, $10,000 or $20,000, so that was okay. He said, which one do you recommend? And so I actually took him to the numbers, to the values, and that's what I want to take a look at with you guys here today. So let's go ahead and type it in, and we'll walk through it. You will take a look over at the screen here now. What we're going to have is a home price of $100,000. Now, of course, a pretty generic 30-year mortgage is what he was going to get, and he told me that his interest rate was going to be around 4.5%. Okay. Now, his first option was a down payment of $10,000, and so we'll go ahead and calculate that. What that tells me down here is that he's going to end up with a principal balance of just under $90,000, and he's going to end up paying $74,000 in interest over the course of 30 years. Now, he said, well, how much is it? So again, we're at $74,000 of interest. He said, how much is it if I put 20% down and get out of the PMI? We came down here and took a look, and it's $65,000 of interest. So immediately he perked up. He said, well, that seems a lot better to me. I don't like to give up money to the third-party banks. I might put a little bit more down. That'll get me out of the PMI insurance, and it'll cost me or save me interest over the course of 30 years. And I introduced this new scenario to him. I said, well, what if we put $10,000 down, and as soon as you have the mortgage, we make a one-time additional single extra payment of $10,000. That actually takes your interest paid to $50,000. It's the same $20,000 that you wanted to put down. You'll still be able to get out of the PMI, the private mortgage insurance, because as many of you know, all you have to do is have 20% of your house paid for with an appraisal. Now, the original appraisal that he's going to get to purchase this house will still count if he does this, because he's going to be able to do it within the first 30 days of owning the property. But now he only has to pay $50,000 of interest, and he almost lost it. He was like, what in the world just happened? And it's the same thing that I want to explain to you here today. What happened is the interest that is accumulated on a mortgage is amortized on an amortization table, and they front load the mortgage with the interest payments up front. Many of you realize this. Many of you who have 2, 3, 4% interest rates on your mortgage very much realize that every time you make that payment, that's not 2, 3, or 4% interest that you're paying on your payment, right? We talk about this a lot, and there's some other videos that I'll link to that you can watch where we talk about it's not the interest rate, it's the volume of interest that's actually killing you. And so, actually, and again, I'm not saying that you should always put 10 or 20% down. I'm not saying this is how you should buy every house. I'm saying for this particular individual that I spoke to a little bit earlier today and his scenario, it made a lot more sense to actually pay the 10% closing cost, the fee on the mortgage, the down payment, and then throw the additional $10,000 onto the mortgage once he had it. And when he was asking the questions, just revolving around how much money can I save? I don't want to pay interest and I want to get out of the PMI. And so, if that was new for you, it's just a money myth. Putting down more money is the best way, it's the fastest way to save on the interest when in reality, it's actually giving them as little as you can for the down payment and throwing everything additional onto the mortgage payment once you have the mortgage because of the amortization of the volume of interest. So, anyway, thanks for joining us here today. Come back again another day tomorrow, watch a new video where we can talk all about more money myths and money mathematics. I'm Jonah Dew. We're the Banking Bros. Thanks.